Welcome to the Deep Dive. This is where we take that stack of sources you've gathered, articles, research, maybe some notes, and we really dig in.
Yeah, our job is to pull out the most important bits for you, cut through the noise, find those, surprising facts maybe.
Exactly. Give you just enough context so you feel properly informed on a specific topic pretty quickly.
And today we're looking at a company you probably use all the time, maybe without thinking much about it. Mastercard, ticker MA.
Right, and we're examining it through a specific lens, kind of that Buffett Munger idea of our wonderful company.
So, based just on the material you gave us, does Mastercard fit that description? Is it a great business?
And crucially, is it trading at a, let's say, fair price for someone thinking long-term? That's the mission.
We'll be exploring how Mastercard actually makes its money beyond just the card itself, what protects it, its defenses.
How strong the financials really are, and maybe a glimpse into the future. Should be interesting. It's often more complex than you'd think for these everyday companies.
Definitely. Let's get into it.
Okay, so unpacking Mastercard. I think the first really critical point from these sources is figuring out what Mastercard isn't.
Yes, absolutely key.
It's not your bank, right? They're not lending you money.
Precisely. That's a huge distinction. Mastercard is, at its heart, a technology company.
Yeah.
They don't carry the credit risk.
Okay.
They provide the digital plumbing, the network, the infrastructure that lets money move safely between, you, the merchant, your bank, the merchant's bank.
They're the connection, the essential layer. And because they don't have that credit risk, their revenue is incredibly stable, right?
Remarkably so. It's not tied to whether someone pays their credit card bill. It's linked directly to the volume of money flowing through their system.
Yeah, the sources showed revenue only dropped once since 2002, and that was 2020, the pandemic year.
Exactly, which just shows how, embedded they are in the global economy. It's essential.
So how does that revenue actually break down? The 2023 data you had pointed to two main parts?
Correct. Two major segments. The biggest is what they call the payment network. About $15.8 billion in 2023.
And this is the classic business everyone thinks of.
Pretty much. Growing nicely, too, about 10% year over year. This comes from fees the banks pay, based on the transaction volume, the GDV.
So domestic transactions, the processing itself, and cross-border stuff.
Right, and cross-border is important. Those transactions, where the buyer and seller are in different countries, tend to generate higher fees for Mastercard.
Ah, okay, so volume and the type of volume. Makes sense. It covers credit, debit, corporate cards, all that.
Yep, prepaid, disbursements, even newer things. But then there's the second segment, and this is where the story gets, more dynamic.
Value-added services.
Exactly.
Yeah.
This was $9.3 billion in 2023, but look at the growth, 18% year over year. Much faster.
Okay, 18%. So what is this stuff? It's not just processing the payment.
No, it's all the extra intelligence and tools they layer on top. Think cybersecurity services, fraud prevention for the banks and merchants.
Right, okay. That makes sense.
Plus data analytics, consulting, managing loyalty programs, gateway services. It's a diverse mix and really strategic for them.
Strategic how? Why is this shift important for you, the listener, to grasp?
Well, it shows Mastercard isn't just passively collecting tolls on payments. They're actively becoming a broader tech and data company for that whole payment world.
Changing their growth story, and maybe their defensibility, too.
Precisely. And they do this everywhere. Over 210 countries, 150 currencies. It's a massive global footprint.
And international is key, right? Like 67% of revenue in 2023, growing faster than North America.
That's right. So, the underlying tech can be complex, but the basic idea, earning fees on transactions, selling extra services.
That part seems pretty understandable. It feels like it fits within a reasonable, circle of competence.
I'd agree. Which naturally leads us to, how do they protect this business? The economic moat.
Ah, yes, the moat, keeping competitors away. The sources mention a guru-focused score, 9 out of 10. Wide moat.
That's a strong signal.
Yeah.
And you look at Mastercard, the moat feels, deep.
Several layers. The most obvious one has to be network effects, right?
Absolutely. That's the powerhouse. It's that classic virtuous cycle. More people have the card.
The more stores have to take it.
And the more stores take it.
The more useful the card is for me. It feeds itself.
Exactly. And the scale is just immense. Billions of cards, thousands of banks, tens of millions of merchants. How does a competitor even start to replicate that?
It seems almost insurmountable. Then there's the brand.
Huge. That logo means trust, security, acceptance. In payments, that's gold. It's a major intangible asset.
And what about switching costs? especially for the banks.
Very significant. Banks weave Mastercard systems deep into their operations. Card issuing, fraud detection, loyalty. Switching networks is a massive, costly headache.
Disruptive. And merchants rely on that wide acceptance too, right? They don't want to turn away customers.
Definitely. Then you got pure economies of scale. Building and securing that global network costs a fortune. But processing one more swipe
costs almost nothing.
Right. So as volume grows, their cost per transaction drops.
Yeah.
Gives them pricing power, cost advantages, high incremental profit.
And lastly, intangible assets, like their tech.
Proprietary tech, all that data they have, patents, and they keep investing heavily in things like AI, cybersecurity, biometrics, staying ahead.
So put it all together. It looks like a really durable moat. Visa's obviously a huge competitor, similar model.
True. But the industry seems big enough for both giants. And while newer fintechs, BNPL, they're threats, Mastercard is actively responding, not standing still.
You see the moat's strength in the financials too, right? Those consistently high returns, market share, the massive cash flow.
Absolutely. And they're not just defending the moat, they're actively deepening it, especially with those value-added services.
Like through acquisitions. You highlighted a few from the sources. Dynamic yield, Ekata, recorded future.
Exactly. Dynamic yield for personalization, Ekaya and Finicity for open banking in Europe and North America, Ekata for digital identity, recorded future for cyber intelligence, Safer Trace for crypto risk.
These aren't just random buys, they're strategic. They make Mastercard stickier, right? More embedded in what their clients do beyond just the basic payment.
Precisely. It's transforming them into this broader tech and data partner.
And you mentioned this helps clarify that confusion around interchange fees.
Yes. It's common misunderstanding. Interchange is a big fee for merchants, sure, but the largest chunk goes to the bank that issued the card, not Mastercard itself.
Okay. So Mastercard gets smaller fees, assessment fees, processing fees.
And increasingly, fees for those value-added services. Their strength comes from the sheer volume on the network being indispensable, plus selling these valuable extras.
Got it. So it's not just about taking a big cut of interchange. That's important for thinking about regulatory risk. Their model is more diversified.
Exactly. Which brings us to management and the financial engine itself. Michael Miebach, the CEO, he was key in this strategic shift even before taking the top job.
Yeah, the focus seems to be on core payments, yes, but also these new flows like B2B and really pushing those value-added services, creating a, quote, virtuous cycle.
Sounds about right. And their capital allocation really reflects this. It's a balance.
A balance between reinvesting heavily.
Which they do. CapEx was, what, $1.19 billion in 2024?
Yeah.
Pouring money into AI security, new platforms.
On returning cash to shareholders?
Right. Strategic M&A is part of that reinvestment, too.
Yeah.
Those companies we listed, Dynamic Yield, Ekata, Recorded Future, cost $2.65 billion reportedly. They spent $2.8 billion total on M&A in 2024. It's how they accelerate into new areas.
And then the direct returns. Share buybacks. They seem incredibly aggressive here.
Very. A new $12 billion program announced. After an $11 billion one, they bought back $11 billion worth in 2024 alone.
Wow. And that's brought the share count down significantly, from over 1 billion to around 927 million.
Yeah, a clear way to boost shareholder value. And they also pay a growing dividend.
Just raised it 15% to 76 cents quarterly, growing consistently.
But the payout ratio is low, right? Around 23%.
Correct. Which tells you most earnings are plowed back into the business or used for buybacks. Makes sense given the high returns they generate internally, but shareholders still get that rising income stream.
And management seems aligned, with pay tied to performance. So overall, capital allocation looks smart, feeding the growth engine, enhancing the moat, and rewarding owners. Funded by
that incredible cash flow, which leads us to the financial strength overall. This is where the wonderful company idea really shines in the numbers.
The growth has been solid. Looking at 2019 to 2024, net revenue grew about 10.8% compounded annually, up to $28.2 billion. Operating and net income saw similar healthy growth.
But the profitability is just stunning. Operating margins consistently around 55%, net margins near 45-46%.
Yeah, those are elite numbers, way above average.
And the returns on capital, this is maybe the killer metric. Return on invested capital, ROIC, 59% TTM. 5-year average around 48%.
Phenomenal. Return on equity also cited around 48%. It means they reinvest capital back into the business and generate extremely high returns on it.
Wow. That's the compounding machine idea, right? Great business, and they deploy capital incredibly well.
Exactly. And fueling all this is the free cash flow. Just prodigious amounts. $13.6 billion in 2024, over $14 billion TTM.
And the FCF margin, over 53%, converting more than half their revenue straight into free cash.
Incredible efficiency, cash that management can use to invest, acquire, buy back stock, pay dividends, lots of flexibility.
So financials look amazing. But, okay, the balance sheet. Debt has gone up. $18.2 billion in 2024. And some sources flag a high debt-to-equity ratio, maybe over 6x.
Right, and that debt-to-equity number can look scary if you just see the headline figure.
But there's context.
Crucial context, the sources explain it. That ratio is high largely because the aggressive share buybacks have shrunk the equity denominator on the balance sheet over time.
So it's not necessarily massive debt load, it's a smaller equity base due to returning cash.
Precisely. A better measure, especially for a stable cash generator like Mastercard, is debt to EBITDA, and that's very low. Around 1.0, maybe even less.
Okay, so debt to EBITDA, annual earnings could basically cover the debt in about a year.
Easily. Given the huge, stable earnings and cash flow, that debt level is perfectly manageable. It looks like smart, strategic use of leverage, not financial distress.
Okay, that makes sense. So the picture from the sources seems really strong, wonderful company characteristics check out. Which brings us to the final piece. Valuation. Is it a fair price?
Always the tough question. And Mastercard, well, it consistently trades at a premium. Late May 2025 figures showed a PE around, 39.41. Price to free cash flow similar, 37.38.
Definitely not cheap compared to the overall market.
Nope. But importantly, those multiples are pretty much in line with where Mastercard has traded historically over the last 5 years or so.
So the market consistently awards it this premium, recognizing the quality, the moat, the growth.
Seems that way. Investors are willing to pay up for that expected continued excellence.
But the implication is less margin for safety. If growth hiccups or the moat erodes unexpectedly, that premium multiple could shrink, hurting the stock price even if the business is still okay.
That's the risk with premium valuations. It demands continued strong execution.
So can they deliver that growth? What are the drivers looking forward?
Several key ones highlighted. The big secular shift, from cash to digital payments. Still a long way to go globally.
And those value-added services again. Higher margin makes them stickier, huge focus.
Absolutely. Plus, tapping into new payment flows, think B2B payments, account-to-account, government disbursements, things like Mastercard Move target these massive opportunities beyond consumer cards.
Constant innovation needed too, right? AI, digital identity, open banking, blockchain, staying ahead.
For sure. And international markets, where they already dominate revenue-wise, still offer faster growth potential. Plus, cross-border volumes recovering and growing with travel and e-commerce. That's high-margin business.
Analysts seem optimistic. Forecasts generally showing solid revenue growth, maybe high single, low double digits, and EPS growth even faster.
Yeah, typically in the low to mid-teens for EPS, helped by the buybacks and margins.
Okay, but no investment is risk-free. What are the big long-term worries the sources flagged?
Regulatory pressure is a constant. Global scrutiny on fees, network fees, interchange fees, antitrust concerns. It's always there and can impact the business model.
Management focuses heavily on this.
And competition. Visa, obviously, but also FinTechs, BNPL, local payment networks, maybe even big tech eventually.
It's an intense space, plus the risk of technological disruption. Could something completely new bypass the networks? Less likely, maybe, but possible. Requires constant vigilance.
Cybersecurity has to be huge, too. They're a massive target. A breach would be devastating for trust.
Absolutely critical. Their acquisitions, like Recorded Future, show they're investing here, but the risk is immense and ongoing.
Then the usual suspects. Macroeconomic headwinds, recessions impacting spending, inflation, rates, and geopolitical risks given their global scale. And finally, that dependence on financial institutions as partners. They need the banks.
So yeah, a lot of future growth hinges on executing well beyond just the core card processing. Those value-added services, new flows. It's smart diversification, but it also means evaluating them as this broader FinTech data player.
Which comes with its own execution risks, moving into areas adjacent to, but maybe slightly different from, their historical core.
Okay. So wrapping this up based on the source material, Mastercard certainly looks like a wonderful company, checks the boxes, strong moat, fantastic financials, capable management, clear growth paths.
Definitely fits that description. The fair price aspect is the debate. It trades at a premium consistently. Reflects the quality? Yes, but it's not objectively cheap.
Whether that premium is fair depends on your confidence in continued execution and your investment horizon, I suppose.
Exactly. It seems the market price is in that continued high performance. The key going forward will be watching execution on the strategy, VAS, new flows, M&A integration, plus the competitive and regulatory landscape.
This deep dive really illuminated the layers beneath that familiar logo. It's much more than just a payment processor.
It really is. Which leads us to a final thought for you, the listener, to consider. As Mastercard keeps evolving, becoming less about just the card swipe and more about being this broad financial tech and data services company, what does that really mean for its identity? Who are its real competitors now, and just how far can this transformation take them?
Interesting questions to ponder. Thanks for digging into these sources with us today.